Using a financial advisor can be a big waste of money, or it could be the best money you've ever spent.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
Hi, Roger. This is John. I'm 56 years old and married and have about $2 million in assets, not including my house. I'm currently without a financial advisor, and I'd like to get one, but I'm getting cold feet because of the cost. Can you explain why the range of fees for financial advisors is so broad and why the cost seems to be so high? I've seen fees as low as 0.5% and as high as over 2%. And against my $2 million that I'd like managed, that's 1% is $20,000 annually, which seems like a lot of money. Can you explain how I can justify that cost? Thanks for taking my question.
John asks, can you explain how I can justify that cost? It's a great question, John. It's one that anybody that uses a financial advisor needs to evaluate in a systematic way. And anybody that's considering using one, like John, needs to evaluate when they're talking to an advisor to help them with their situation. And we're going to try to answer this in the Hot Topic segment. But before we do that, understand the advice industry is in a period of a major transition from a Salesforce-based industry that sold stock trades, research, tools, and investment management to more of a holistic planning industry where we're advising clients not just on investment management, but basing the value proposition on the entirety of a client's life and making all those little decisions. We're in that transformation, and transformations are messy in that the current workforce of advisors, which is more on the elderly side, I forget what the average age is, were never trained to be more than investment people. The big firms that train advisors trained only on investment product and sales presentation, and advisors generally got into the business to focus on investments and sales. But the world has changed with the advent of the internet and the disintermediation of all the things that advisors had control of: research, allocation tools, trading, quotes at one point. And the advisor has had to adapt. Most advisors were never trained, though, to provide a more holistic value proposition. And that's one reason why we have the range of fees all over the place and, bluntly, range of competencies in truly adding value to people's lives. So it makes it hard for you guys. So we're going to try to give you a framework to navigate this advice industry after this disclaimer. Time for that all-important disclaimer. And given the topic of today, I do have to disclaim the fact that, hey, I'm sort of talking my own book, they talk about, meaning that I am a financial advisor. I charge based on assets that we manage. And I'm about to talk about how an advisor should add value and whether it's justifiable. Obviously, I think we add enough value for the fees that we charge, but that's sort of talking my own book when I frame how to think about this. So just to disclaim that, if you are not currently a client, don't take advice from me. I only work as a fiduciary for clients. And before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor. We may talk about some investment topics today. So remember, investments have different types of risk. Past performance doesn't guarantee future results. And if we happen to mention an index, you can't invest in an index. So make sure you make decisions that are right for you and talk to the people that know you. Now let's go figure out whether an advisor can add value and how you would quantify that. As I mentioned at the start of the program, an advisor can be a colossal waste of money, or it can be the best money you've ever spent. It just depends on what you need and what you're hiring them for. So the traditional value proposition of financial advisors is investment management in building smarter portfolios, finding investment vehicles that can outperform the indexes. But that doesn't work anymore. It requires so much outperformance because of fees and taxes that the expected outperformance is pretty unlikely. And the success is dependent upon a lot of the things the advice industry cannot control. I always say that when we talk about, market outlooks and changing the data that we have, is we don't want to base our value proposition on predicting markets, finding the best managers, timing the markets consistently. We want to base value propositions on things that we literally have no control over. Probably better to give the promise of process and discipline to have the right little conversations rather than trying to be the smartest person in the room and predict the future. So I'm going to approach John's question of how do you justify the fees that you might pay for a financial advisor in two different ways. The first way is we're going to try to quantify it using Vanguard's Advisor Alpha study. And you can Google that. They've been doing this study to try to quantify the value of advice. And then I'm going to give you a little bit of my own take of where I think the return on investment can come if you're working with the right advisor. And that's a big key because there are more wrong advisors than right advisors, in my opinion, because we're in this period of transition and evolution from an advice industry standpoint. So Vanguard did this Investment Advisor Alpha study where they tried to quantify or identify where financial advisor can add value, and they tried to quantify that in terms of the kind of returns you might expect. So we're just going to run through some of these, and you can find the study online. The first area they think an advisor can add value is a suitable asset allocation and diversification. So that could be the appropriate risk level. It could be how diversified you are, not too much, but not too little. Not too little is easy because you can think of being concentrated in one stocks, but it's very easy to be way over diversified and make it much more complex than you need to. A good example is they looked at endowments, these endowments or foundations that use lots of alternative investments in real estate and other things. And they compared it over a 1, 3, 5, 10, and 15-year period over just a 60-40 bond stock mix, or stock 60%, 40% bonds. And they looked at the average returns from the basis of the study, and they found that really there was no major outperformance in having all of these tricked up alternative investments. At the end result, at the end of 15 years, all the returns ended up being fairly close to the same. Except with the 60-40 more basic portfolio, you had a lot less fees and a lot less mental hurdles to go over, and it was a lot more efficient tax-wise. So it's not just about being under-concentrated, like having too much in one stock or one fund, but it's also about not making it more complicated than it needs to be. Now, it's interesting because I see this a lot when I'm bringing on a portfolio with a client. I think the latest one, it was Fidelity has this, they will manage an asset allocation for you and you pay them a little bit additional over the mutual funds and they'll determine your asset allocation and they'll implement it. And a lot of the accounts that I brought over, this particular one, I think it had like 35 different mutual funds, which just way overcomplicates it in my opinion. So that's one value. Now, Vanguard, in terms of trying to quantify this, they couldn't put a number on this because they said it was too individualized. So the second area they looked at was the cost-effective implementation of the plan. So what fees you're paying. So if you have gross returns, the return of whatever market you're in, minus your fees and minus taxes gives you your net return. And that's something that an advisor can help with, is making sure that you're not wasting money on overpriced investment options that are not adding any value. And Vanguard estimates that an advisor can save you about 40 basis points a year by doing this. Now, what's a basis point? That's like 0.4%. It's just a fancy term for saying almost 0.5% a year. Vanguard has determined that an advisor could potentially offer about 0.5%, a little less than 0.5% a year in value by making sure you're effectively implementing whatever asset allocation you've determined. The third area that Vanguard studied was rebalancing. So if you have an asset allocation, let's stick with that 60-40 stocks and bonds allocation. Most likely over time, the stock portion is going to outperform, right? And sure has recently, which means that 60% in stocks will probably grow faster than the bonds, which means your allocation will be different. You'll like it because you're getting better returns as that stock portion gets to 65, 70% while it works. But now you have a different return risk profile than you originally started with. So the concept of rebalancing is every year, or however often you determine, you sell your winners that are a little bit too big than what you determined, and you rebalance back to, in this case, that 60-40 stock bond allocation. An advisor, Vanguard says, could potentially add 35 basis points, or about 1/3% a year in value to a client. That's real money, by sticking to a very disciplined rebalancing strategy. Now, why is that? Well, rebalancing is always a little bit of an emotional challenge, right? Because if stocks do well and they outperform, usually we're happy with them when they're outperforming. And our natural inclination is to want to buy more, right? Who doesn't want more of a good thing? Well, rebalancing makes you sell the thing you want more of and buy the thing that has lagged in performance, probably the thing that you want less of. It's a disciplined habit of buying high or selling higher and buying lower, knowing that you're maintaining the risk reward profile that you originally put together. And over time, studies have shown it's really helped a portfolio. So that's one reason why a lot of us don't stick to the rebalancing, because it's a little counterintuitive. It's making us, move away from things that we really enjoy and move towards things that we're not that thrilled about. Another area that I don't think Vanguard factored into this study is doing rebalancing in a cost-effective way, meaning doing rebalancing in a way of helping minimize taxes and minimize trading costs. I think there's some value to be added there that I don't think they captured in that. But that's the third area that Vanguard looked at. The fourth area Vanguard identified, which they say could add up to 1.5% a year in returns to a client, is behavioral coaching. And it is, I think, I agree, a very big part of a financial advisor's job. The premise is, though, that they have discipline and a process in their own practice to be able to provide that coaching. I've seen advisors that get fear-ridden and greed-ridden just as easily as clients. But what ends up happening when we're investing assets is all the due diligence of process, all the due diligence items that need to go through with a manager. Ultimately, a lot of times it ends up coming down to trailing performance and intuition. We tend to think that we inherit the trailing performance of whatever investment that we buy. Even though past performance is no guarantee of future results, we see those numbers as a feature or benefit, and when we buy them, we think we inherit them. So what ends up happening is we end up moving money towards things that just did well and taking money out of things that just did poorly. And this happens over and over and over again. And I'm not just saying that. I mean, the flows of where people put money into, say, mutual funds back this up. As an example, let's go back to 1999 when we were in the tech bubble, when technology stocks or stocks in general were totally outperforming bonds. During that time frame in 1999, that year, about $162 billion went into equity funds after the markets have substantially gone up. And there's about $7 billion that came out of bonds. Now, in 2000, we had another great year, and another $258 billion went into stocks, and about $51 billion came out of bonds. This is investors putting money to work in mutual funds and other things. Well, then we had the big market correction of 2000, 2002, and we saw everybody pile into stocks right before they went off a cliff. Now let's fast forward to 2008 to 2012. So the bottom of the market was March 9th, 2009. Everybody knows it's my son's birthday. And since then, the markets have been on a tear upwards since that bottom, for the most part. Well, from 2008, end of 2008 to 2012, pretty much after all the damage was done in the stock market, investors pulled out about $58 billion from the equity markets after all the damage was done in stocks. And they plowed about $1.2 trillion in bonds at historically low interest rates. So after all the damage was done, we ran out of the things that performed poorly and we ran into the things that felt safe at the time. That's where behavioral coaching can really come in. And then another area is where we're very susceptible to what I call the squirrel effect. Squirrel, a new fancy investment opportunity or a better, faster duct tape solution to whatever we're feeling. And I think that's where the behavioral coaching really comes in. And Fidelity backs us up. They say it can add about 1.5% a year, having that discipline to a plan that's thoughtfully planned out. The fifth area that Vanguard says an advisor can add value is an asset location, meaning when you're implementing your portfolio between stocks, bonds, real estate, and all those other things, having some thoughtful decisions on which assets you put in which tax categories, what you put in your tax deferred account, what you put in your taxable account or your Roth account. Vanguard estimates that an advisor can save up to 0.75% a year or add value of 0.75% a year just by asset location. And then number 6 is spending strategy, helping clients determine where to access money in retirement. And Vanguard says they could add up to 1.1% a year in performance, alpha, through thoughtfully thinking through a spending strategy. Again, you can Google this online. It's the Vanguard Advisor Alpha Study. And they average it all out and they say a good advisor that is proficient in these areas can add potentially about 3% a year in net returns. Now, they say, and this is important, I think, is that it happens in chunks, right? The return experience on the value of an advisor, it's going to ebb and flow based on the particular client and the particular situation and market. So it's not like it's every single month that there's value being added there. It's going to be in these very critical lifetimes, whether it's in the behavioral aspect or the allocation aspect, that an advisor is going to add value. Well, and it would be awesome if you could just hire the advisor during those little pressure points when you needed them, right? The difficult part of that is they're not really going to understand you. They're not going to have enough shared history to really speak deeply into whatever situation you're dealing with. Now, so that's Vanguard's Advisor Alpha Study. And what I thought interesting about that is it's still limited in my aspect of the value that an advisor could add, the right kind of advisor, especially when we're in retirement or nearing retirement, because this is all still focused around investment management. So there is value to be added there if there's really a disciplined process that someone follows. So another way to think about it is what other areas could the right kind of advisor add value outside of just simply the investment management? And this is where I think the important opportunity is. And this is where, in addition to the things that we're talking about here that Vanguard points out, this is where I'm basing my value proposition and justifying my existence in working with clients. And that is all of the little decisions along the way, pretty much all the stuff we talk about in Retirement Plan Live, whether it's getting confirmation and enough clarity to be able to save less now so you can enjoy more now from a family perspective, whether it's navigating intelligently what that spending plan will look like so you can maximize the go-go years in life, whether it's helping someone figure out how much risk they need to take rather than what they can tolerate in order to add some quality to their life in terms of not worrying about it. Managing that cash flow, helping them decide, do I buy that second house? Do I sell this house and downsize? What would happen if I bought that RV, house, business, and it went wrong? Am I handicapping where my family's going to be 5-10 years from now in some big way? I think there's a lot more qualitative things that the right kind of advisor can help clients navigate that, in my opinion, can only be done when there's some shared history there. Obviously, the things Vanguard talks about, if you can add the value to justify fees there, or avoid decisions that could cost hundreds of thousands of dollars or cost time with family because you never evaluated the long-term impact of what that decision might do. I think that's where an advisor can add a lot of value. Unfortunately, I think there are very few advisors that intentionally think about those things and then have created a process to actually have those right kind of conversations in order to add value. So my opinion is, John, is if you're going to use an advisor, unless you truly don't want anything to do with investments and you just want to turn everything over, the value should not be in investment management. I think the value should be in what Fidelity talks about, because that's nuts and bolts things. But then it's the holistic strategizing and having someone that has walked the journey hundreds of times, that has this history and this network of wisdom built up, that's going to help you with risk management, cash flow and budgeting, forecasting, retirement planning, income tax planning, elderly care, and charitable giving, and making sure that you're being a good steward of the family. I think that's really where the value is. And then in this day and age where if you're working with a fee-based advisor and there's no sunk cost, it's a continual evaluation process. Because when you sign up and you're working with someone, if you're not seeing the value, you can always disengage from the relationship and the fee stop. So hopefully that gives you a perspective. We're going to have a long show because now we are going to talk to Nicole about answering some of your questions. Squirrel. Nicole, do you get distracted by squirrels?
No.
Well, you saw in this last week's Six Shot Saturday, there's the movie Up. Remember the movie Up, the old guy in the house? I do remember the movie Up. Right? And there's a dog called Doug, D-U-G, Doug. And he'll be talking to you really, friendly, and he's really focused on you, and he's focused on the task, and all of a sudden he goes, squirrel! Because he gets distracted by a squirrel that catches his eye. So do you get distracted by squirrels?
I have many problems, but I don't think that's one of them.
Well, squirrel, obviously, I'm not talking about the actual squirrel.
Yes, I know. Figurative squirrels.
Yeah, and I think we get distracted, and I put this in the note in last Six Shot Saturday of, from an investment standpoint, it's easy to get distracted by squirrels, a greater investment or market news. And even in life, it's easy to get distracted by squirrels, right? I mean, you got two young kids. When they're home and they need your attention, it's easy to get distracted by the TV, by Facebook, by lots of different things where you're not spending the time on the things that are actually important to you. And our world, I think, is full of squirrels.
It is.
So one of my goals is, and I've talked to Nicole about this, is it's okay to go squirrel, but then you have to refocus on the important things. So I was just curious if you had squirrels other than your two little squirts.
I can't think of many off the top of my head.
See how perfect Nicole is? It's so frustrating.
No, okay. That's not true.
Anyway, we have some listener questions. So why don't we get to the first one?
Okay, our first listener question is from Kelly, who wants to know how you suggest taking equity from a house if needed.
Now, we get lots of listener questions, and I want to give Kelly the prize for the shortest, most concise listener question.
No squirrels for Kelly.
No squirrels. Straight to the point. How do you access equity from your house? That's a big deal because obviously home values have risen a lot over the last 8 years since the Great Recession. And baby boomers as a whole look at, their homestead and have really built up a lot of equities through paying down mortgages. And then they find themselves in retirement with this house, which could be worth $500,000, $1 million, whatever the number is, depending on where you live. But they can't use that money to support their lifestyle. And that's why on a balance sheet, if you look at your net worth statement, you have tax deferred, after-tax money, tax-free money, all those types of things. But there's also another category that we forget about, which is productive assets versus use assets. You know the difference, Nicole? Like, what's a productive asset?
A productive asset like your IRA?
Something that is either throwing off income or you can access for an investment opportunity or to support your lifestyle. It can be productive. Now, compare that to a use asset like a house.
Your car.
Yeah, your car, which is a depreciating use asset. But like with your house, if you have $1 million house, and I think this is basically Kelly's point, well, that $1 million is there on your balance sheet, but it's not producing anything for you, right? It's not throwing off income or dividends. It may be growing, but you can't really tap it until you stop using it. So that's the difference between a use and a productive asset. So how do we turn this use asset, our house, into a productive asset to help provide for whatever we need, whether it's retirement, college, and things like that? Well, I see a couple different ways. Number one is what's called the home equity loan, right? You have equity in your house that you can tap to by putting a loan against it and make payments on it. And then you have to pay that money back. It's like a second mortgage, something a lot of people use. Some of the downsides to a second mortgage is that when you do a second mortgage, you get all the money. So if the second mortgage is for $50,000, that money hits your account whether you need $50,000 or not. So you're going to be paying interest and payments on that, even if you only really needed, say, $10,000 to take care of something. And then a second home equity mortgage is going to have a set term and it's going to have payments, much like a normal mortgage. Now, a second type of loan you can do against your home to access equity is what's called a HELOC. You know what a HELOC is, Nicole?
Home equity line of credit?
Bam! Yes, home equity line of credit. So that's like a line of credit you would get at a bank, except they're using your house as collateral. And it can be a lot more flexible. So let's say you have $300,000 equity in your house. You could get a home equity line of credit, depending on what state you live in and all the regulations, of $200,000. So the bank, you do all the paperwork, and the bank says, okay, you can tap this line of credit, which is basically like a credit card using your house as collateral, of $200,000, but you don't have to do it right away. And you're not paying interest on the line of credit until you go and access money. It's like a credit card. It can sit there with a credit limit, but you're not paying any interest or payments until you tap it. And some of these HELOCs will give you checks or even debit cards to be able to access that HELOC in order to, whether it's supplement your lifestyle, buy a car, pay for college, go to Europe, whatever it is. And then you only make payments on the amounts that you access. And usually there aren't any closing costs. Now, some of the downsides to this and a lot of these strategies is, man, when you have access to debt or lines of credit, it's easy to go think it's your money and you buy jewelry, you spend it on things that really aren't top priorities. That's always a risk for all of us. Another one is with a HELOC, similar to like normal lines of credit that business owners have. The joke is the only time you can get a line of credit is when you don't need one. So banks can cancel them. And usually they're going to cancel lines of credit when there's stress in the economy or in the home market. Usually they cancel them when you actually need them most. So there's always that risk there. The third way is there's what's called a reverse mortgage line of credit, which is much more permanent than this HELOC concept. Fees are higher, but the banks typically can't cancel it. And there's a good article that I'm going to have a link to in Six Shot Saturday in Forbes that describes this reverse mortgage line of credit. And I'll be honest with you, I'm not 100% familiar with it. I've never used one. So I'm going to link to that article, but that's something that's a little bit newer that may have some application. So I'm going to have to explore that one further. And then you have, the more normal things of a cash out refinance. So you refinance the house and you take some of the equity out, or your traditional reverse mortgage, which can be quite expensive and has a lot of gotchas in it. But the last one I want to talk about is probably one of the safer ways of doing it, meaning that you're not taking on debt in order to access the equity in your house. And that is creating a roadmap where at some time you turn that use asset into a productive asset. How do you think you would do that, Nicole?
Renting out a room?
Well, you can do that. You can do VRBO. Right? I have friends and we've talked about using, turning it into an asset. So when you travel, you can earn income off of it. Another way, and this is the way I'm working on with my wife, is usually when we're entering retirement, we have homes that were built for the use of raising a family, right? And that can include lots of square footage. It can include pools. It can include landscaped property so the kids could run around. Well, when you get into retirement, a lot of times we have homes that are way too big for the life that we're going to lead, but we like it. My generation, the baby boomer generation anyway, is much more into having this home casa, having that house. And there's nothing wrong with that, but it should be on the table, at least for discussion. How long do we want to have this homestead with the pool and the property and the square footage? And then when do we want to simplify? Are you going to be able to take care of that house from a financial perspective, the taxes, the utilities, the landscaping, the upkeep, getting up and down stairs as you get older? how long do we want to have all of those burdens of homeownership to that level? And when do we think we want to simplify or right-size our life for the new journey that you're on from a retirement perspective? Everybody's different there. But in the planning phase, I think it's something that you can build a roadmap to. I've had clients where the one I talk about all the time is someone who's on a ranch, and it was a really important ranch to them, and we figured out how long they could stay on the ranch, and then when they simplified, and we've gone through this transition with them already, they knew they couldn't stay on the ranch long term, and it had too much equity to make any sense. But they were able to stay on it early in retirement when they could really enjoy it. And then they simplified and turned a lot of that equity in that ranch into productive assets, plus shed a lot of the burdens of all the upkeep of the house that they had. So I think that's a strategy that we don't think about enough when we're thinking about how to tap home equity. And that doesn't involve taking on debt against a use asset that you already had. So hopefully, Kelly, that gives you some flavor for how you might be able to tap equity in your house.
Short question, long answer.
What? Well, there's a lot of things I could have got a lot
of things to consider.
You never know how far to chop up the onion. I try not to get too granular. And we had our geeky show last week. I'm trying to stay high level here this week.
That's true.
Yeah.
The next question is not really a question. It's a comment from Tom, who says that he wants you to know he appreciated the book recommendations on your podcast. He wants to recommend a book of the decade called Resilience by Eric Greitens, not sure on the pronunciation there. Tom says his insight into overcoming hardship and growing is just amazing.
I added that to my reading list for this year. You know, what I like about that recommendation, Tom, and I'm excited to read that, is that as we're entering retirement, or even as we get older, let's face it, we have a lot of growing that we do. We have a lot of hardship. There's a lot of emotional stuff packed in the closet that can trap us from making the most of the only life that we have as we enter retirement. So I'm anxious to read to see what insights Eric has regarding this. And then, Nicole, when is it? Is it next week or the week after that we are doing our book recommendations for 2018?
I think it's the last week of January, so another...
Let me check here. Check. Yeah, it's the last week of January, 1/31. So we'll have this book on there, but we're going to talk about books that I have on my reading list. And Nicole, maybe you can add a few. I don't want any like historical romance things, though, okay?
I do not read historical romance.
There's nothing wrong with that. I'm not saying there's anything wrong with that, but I don't know if this is the target market for that.
Okay. All right. Our next comment is from Frank. He says, even in our 50s, we don't feel like we used to. So imagine what the 70s will feel like. People point out that we're living longer, but quality of life improvements have not kept up with longevity. They've cured the things that can kill us, but dealing with recovery, energy levels, aches and pains, there hasn't been as much progress. This is a good argument for the go-go 60s and spending more upfront in retirement if you can. A lot to think about.
True, to a point. So I had a meeting yesterday with a client who is 75. She's still in her go-go years. She is more active than I am. I feel like she is, from a physical perspective, from a mental perspective, she's a sharp lady and she is enjoying life. Now, I've worked with her as a client, for like 17 years now, and she's been intentional about it. So I get your point about, we've cured a lot of the stuff that can kill us, a lot, that will end the life, but it's that, as we get older, the stuff that degrades the quality of our life, we're still dealing with that. I personally think that we're just entering the renaissance of that part of the equation, of that quality of life thing. Yeah, we went from cures, now we're like, okay, what do we do now that we're extended life, because it can still sort of suck, to improving the quality of life. And I think we're going to see, and we are seeing a lot of things that are being done there. I typically see the no-go years starting more and more in the 80s, where we have, the Alzheimer, more the mental things that are coming up as much as the physical things. But you're right. I think it does pose the question of, and we're going to talk about that, I think, in the next question, of what are we trying to accomplish here when we leave full-time work? We're trying to maximize our lives and whatever that means to you, whether that's in volunteering, whether that's in children, whether that's in exploring the world, who knows, or hobbies. And I think there's a really good argument for those go-go years and those slow-go years and planning for those. But I think it even becomes more important to invest in your health and invest in your relationships, because those are the two foundational things that are going to support not just a great go-go year period of time, but a better quality of life when you're in your 70s and 80s. And we can discount that so much. So when I say invest in your relationships, obviously it's your marriage, but the social relationships, and we've talked about that a lot. We're going to have a great guest on in the next few weeks on marriage, who's 70 and they have an amazing marriage. And we talk about investing in your health. And a lot of times we think of the physical investing in our health, which I do a lot of, but there's a lot of mental and psychological investing that we need to do. Resilience, that book may be a great one. The Daily Stoic, which is going to be on my list. That may be on the list. There's a lot of mental and psychological baggage that we need to make sure we're investing in to make all this happen. So, great point. We'll probably do a whole series on this, Frank, but I appreciate you bringing that up.
Our next question is from Jay. He says, I'm seriously considering a target date fund for about 80% of my portfolio. Diversified, good track record, low fees. Is this okay for me to do at this point if I don't need advice from an advisor? Anything I should consider?
I'm not a huge fan of target date funds because I think it way oversimplifies what we're trying to accomplish. They basically work off of 100 minus your age, which was the old rule of how much you should have in stocks, right? So if you're 60 years old, you subtract 60 from 100 and you should have 40% of your assets in stocks. That's an old rule of thumb. That worked more for past generations than it does for you. So Jay, remember, you're likely going to have more financial assets. You're likely going to live a lot longer, have different spending patterns, and spend a lot more than previous generations. And I don't think the target date funds address that. So now, are they bad? They might be an easy go-to option, depending on what your selections are. I personally prefer, if you're going to use these fund of funds, I personally prefer risk-reward target allocation funds that don't slowly change over time. Because these target date funds, the way they're structured is that as you get older, they get more and more heavily invested in bonds. And each one does it differently, so they're not built the same. And regardless of fees, it can cause us to have our portfolios way more tilted to bonds than really makes sense, given the kind of longevity and lifestyle we may live in retirement. So I would much prefer, if you're going to use a simplified version, is just a target allocation fund that doesn't change, so you can manage that risk level and you can maintain it rather than have this change for you. So that would be my suggestion. And then I would add on to that, because I can't help myself, is you may want to target different allocations for different account buckets, right? So your taxable investments may have 3 different purposes. So let's say you have after-tax assets. Because I have some clients that we manage it this way. We have portion A, which is the most conservative, and then we have portion B, which is sort of in the middle, and then a much longer term growth oriented bucket, even just in after-tax assets. Because the key when you're figuring out your asset allocation a lot of times is what's the time frame that these monies are going to be available or needed, and that's going to determine a little bit about your risk profile. So it's not just simply, I am moderate investor. You're going to have different purposes for different accounts or different segments of accounts, and that needs to be accounted for. So hopefully that gave you some feel on target date funds versus what your other options are.
That's all I have for this week.
All right. Then we're going to go into questions pretty much every week now, right?
I think so. Yeah. We have quite a backlog.
Yeah,
so
I think we're going to...
at least the foreseeable future will be questions.
Hey, Nicole, welcome to the Happy Lab.
Glad to be here.
Now, I made you and your husband a little happy, I think, on Saturday when I discovered my new favorite app. So this app, you remember that?
I do remember it. It had me stuck in the Take On Me music video for the rest of the day.
So I'm going to share a couple screenshots in 6 Shot Saturday. It's an app called Sticky. And what you do is you take a photo of yourself, and you can even make it a little GIF, which is like a GIF, which is like a really, really short video where there's just some movement to it. And then when you do that, you can sort of cartoon it or make it look like a coloring book and make it black and white, and you can move it around, and then you can send it as a text or in an email or something like that. So I discovered this, and I literally was laughing out loud in some of the things I was creating, and I couldn't help but send it to Nicole and her husband. So we're going to put some of those in 6 Shot Saturday. So the app is called Sticky, and it's just a cool way if you text people or communicate to send something that's just a little bit, they're like, ooh, that's cool. And you're going to be maybe the coolest kid on the block for a week or so.
Maybe.
Maybe. All right, let's go set a smart sprint.
On your marks, get set.
And we're off to set a 7-day sprint to take a baby step to creating a great life. So, Nicole, the smart sprint I think we need to have people do, given what we talked about in the hot topic segment, is if you use an advisor to evaluate, and this is a good time of year to do it, it's January, what value are they adding? And am I getting the value for the fees that I'm paying? I think now is a good time to evaluate that. There's nothing wrong with paying fees as long as there's value being added. And I think this is a good time of year. So in the next 7 days, you're probably going through annual reviews with your advisor, assuming you use one. Have that as a topic for discussion and do some evaluation just so you can be a good steward of the assets that you've accumulated up till now. So go do that in the next 7 days. That's not what I thought you were going to say. I thought you were going to encourage people to make themselves a cartoon on the Sticky app. Oh, that's a given. That's a given. So you can do that too because you'll have fun. Send me a picture if you do it. So, Nicole, the book comes out March 20th. It'll be in... Wait, that sounded kind of dramatic, not celebratory. I need to work on my music. Well, it will change the world. The book comes out March 20th, but the Kindle and the Nook version are available today. And I get emails when someone leaves a review, and I've been humbled by people seem to enjoy the book, which is awesome with the reviews I see on Amazon. But when someone sends me a review, do you still have books available? We still have books available, and we would love to send them to you. Yeah, and there's some selfishness into this, and it's not you buying the Kindle version to leave a review, but there's about 74 reviews on Amazon right now. And when you get to 125, Amazon takes notice, and it will help get the message out that that's really what's important. So I want to get this book out into as many people's hands because I think it'd help, and I think it could help a lot of people. So go check it out. Nicole? Until next week. You have a great week.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.